Hello and welcome to another episode of Investment Acorns, our exclusive series featuring insights from WhiteOak Capital Asset Management Limited. Joining me is their CEO, Aashish P. Somaiyaa. Welcome, Aashish. Let's begin this conversation with your column, Mutual Funds, Aerated Beverages, and the Quest for Capturing Alpha in Wealth Insight, February 2025 issue. So you argue that alpha in the US hasn't vanished, it's just been repackaged. So how has this shift affected regular investors compared to the institutions?
Just to, kind of replay or quickly give a background, whenever we speak about active management and about alpha generation, I mean, the holy grail of managing money actively is that, one should be able to beat the index. And then, there is clearly this huge debate that, as markets become more efficient, as markets become more institutionalized, as information availability, there's no information arbitrage, it's widely available to everybody. So when some of these structural changes happen in markets, over a period of time, active managers will not be able to beat the benchmark, right? Now, it's true that there are multiple reasons why at various points in time, different active managers may or may not outperform the benchmark. But my point is that to make a structural statement that active managers just can't beat the benchmark, right? And in this, it's always US which is cited as the greatest example. Whenever you discuss within India also, whenever you discuss with somebody about active management versus passive, it'll be like people will hold a discussion for 5 minutes, and in the sixth minute, it will straight away get into US as a exemplar of lack of alpha. That's the reason why I wrote that if you see US itself, there is alpha in abundance. It's just that when everybody tells us that the US market is institutionalized, that's true. But what they don't tell us is that institutions actually put 60% of their money into alternative products, 65 to 70% in alternative products. And by alternative products, what we mean is, private equity, crossover funds, buyout funds, venture capital funds, these kinds of things. Now, it's obvious that, there is a statistic that in the last 35 years, market cap in US is up by about 5x. But Ruchira, can you believe it? When market cap is up by 5x, the number of listed companies has actually halved. Right? Now, just imagine that if you're a manager of public equities, your corpus is going up, but the number of targeted companies in which you can invest is actually declining. And on top of it, what is left for you is large caps and mega caps, where the efficiency and information disclosure or research coverage is that much higher. Yeah. Right? So the whole point is that in the US, yes, there is lack of alpha. Yes, there is institutionalization. But that lack of alpha applies to public equities. And the institutionalization has led to alpha moving into the private market. I think that's the case. That's the data, what it shows actually.
Now, like you mentioned, fewer listed stocks in the US and massive private equity growth. Has public market alpha become structurally harder to achieve?
Yes, of course. The US experience clearly shows that because of the way the things have played out there, it is structurally difficult to generate outperformance. But my limited point is that those same lessons or those same arguments, at least right now, in the near future or maybe for the next few years, they're not applicable to India. If somebody argues with me that India will go that way in the next few years, then that is food for thought. But right now, we are nowhere close.
You also compare active investing in the US to Coke being split into cheap soda for retail investors and, expensive concentrate for institutions. So do you think this regular investors are, they're being misled about the value of active investing?
Yeah, see, it's like this. I love Coke, and so I've just taken that as an example. Basically, it's like this. We know that all these aerated beverages that we love drinking, they are all obviously water and soda water and some kind of concentrate, which gives the flavor, right? And I've taken that as a metaphor for active management, because we all know that active managers, they are benchmarked, versus a particular index. And generally, the performance of an actively managed fund is thought to be composed of the beta itself, which is the index performance. And then you're supposed to do active management in the portfolio by taking active weights, which means relative to the benchmark, you will have some differences, overweights and underweights in your portfolio, whereby you aim to outperform the benchmark, and the outperformance is called alpha. So look at it this way, that active funds performance is basically beta plus alpha, right? For a good manager, the alpha will be positive. For a not so good manager, the alpha at points in time or over a period of time might be negative, right? And the metaphor is that if you take, like I said, any aerated beverage, it is also in the same way a mix of soda water and concentrate, just the way you have beta and alpha. So that's just the metaphor that I have used out there.
Now, unlike the US, India is seeing more new listings and growing retail participation. So does this mean active fund managers here still have a strong edge?
Yeah, see, when I mentioned that in the US, a lot of money has gone into alternates and private markets and those kinds of things, let's understand what happens. In the US, when institutions put so much money into private markets, and private markets are the ones which actually, end up capturing alpha. What do I mean? You will find that in the US, on an average, a company comes to list after it has, on an average, about 15 years of operating history, right? Uber, take an example of Uber. It got listed, I think, at $75 billion market cap, right? Now, that is like, it must be in the top few companies in India. And it just came as an IPO if you were to actually compare,
Yeah.
right? Now, what will happen is that if companies spend longer and longer time in the cradle of private equity, right, then that much value unlocking or value discovery has already happened. And the private equity guys are not operating for charity. When the company comes out for listing, by then it already has a strong brand. It already has operated with an independent board for, say, about 12 to 15 years. Best of auditors, the financials being public. By all means, it could already be a widely accepted brand or a widely known, product. So what happens is that if you see this private equity cult in US is 50 years old. And in India, the private equity cult, I can't say is new, maybe about, say, 20 years old, but it is still in its early stages. We don't have institutions, forget private equity, we don't have institutions putting their money into equity. I mean, only in the last 10 years, the government has prodded the pension funds to start putting money into equity. And that too, those pension funds invest in public equities, insurance companies, pension funds, most of these people, even family offices, even rich people, even for them, private equity is new. It's not like we have 60% allocation to private markets or something like that.
Right.
Right? The private market in India is much smaller than the public market. In US, imagine the size. I mean, last year, just the uninvested dry powder of private equity funds was $1 trillion. Right? So there is more opportunity out there in the private market than in the public market. And in India, like you rightly pointed out, there is more opportunity in the public market, because companies get listed with 1,000 crore market cap and all, right? I mean, 2,000 crore, 1,000 crore market cap. We have guys who are making consumer products like, say, bhujia, potato wafer. All of this is also just about getting listed. Everything from unorganized is getting organized. We have 7,000 plus listed companies if you take BSE and NSE. So we are not at a stage where we are comparable to US. And I think there is a lot of alpha in public market that is yet to be captured, provided managers deploy the right strategies.
Right. Now, the last question. For an average investor, how should they cut through the marketing noise and make a smart choice between active and passive investing?
See, I think first of all, the starting point is that nobody should be, what you call biased on any one side. I think for me, in my journey, I've been in India's asset management industry for about 25 years. About in 2001, when I used to work for ICICI Mutual Fund, they launched India's first ETF. It was called SPICE, Sensex Prudential ICICI. That was the name of the ETF.
Right.
In my previous role, I was CEO of Motilal Oswal. I have played some role in creating products like Nasdaq, S&P 500, and Nifty 500, and the whole basket. And I deliberately worked hard with my colleagues out there to ensure there were open-ended index funds which take as little as 500 rupees. Now imagine that if we could work hard and get you Nasdaq and S&P and Nifty 500 for as little as 500 rupees, what else do you need to begin your investment journey?
Right.
So the point is why I'm giving this is not to rattle out my credentials, but to tell you that basically I'm an open-minded person. I believe that we should offer, investors all the choices. But
Hmm.
then at the same time, investors, advisors, mutual fund distributors, all market participants, they also need to be equally open-minded, and they need to understand that what are they buying for what purpose. Look, if somebody told me that, I don't want to get into selecting which fund, because fund performance keeps changing, right?
Yeah.
And I don't know how to pick a fund. So I say, okay, don't confuse yourself. If you don't know what to buy, you just buy the market, right?
Hmm.
Just buy Nifty 500, correct? Buy the whole market. So the point is that there is applicability or relevance for both. If people are looking for simplicity, if people are looking to, fill it, shut it, forget it, DIY, then they can go for passive products.
Yeah.
But at the same time, there are some people who believe in the other part of the other facet of the same coin, which is that India is a country which offers immense potential. There's a vast part of our economy which is not yet reflected in the market. So how can the index reflect the whole market? So there will be some people who will believe that yes, with certain strategies, alpha can be extracted from the market. And then there'll be people who will say that, okay, for my core long-term holding, I'll just hold Nifty 500. And for some part of my portfolio, I will
Hmm.
hold selected active funds. So my sense is that there is space for both. And, anybody for being successful, the prime requirement for being successful is to be open-minded.
Hmm.
If you are somebody who operates on the fringes or deals in extremes, or if you think everything is just got to be black and white, then I think that's not a recipe for, success.
All right. Well, that was your column in Wealth Insight. Now, moving on to your column in Mutual Fund Insight March 2025 issue, which is the trouble with investment managers' predictions. So, in your column, you mentioned how investment managers they make endless predictions with only the right ones amplified, and yet investors keep falling for them. So, why is it so hard to break the cycle?
See, I think, by nature, human beings don't do well amidst uncertainty, right? For everything, we will function much better if we have complete clarity. Like which are the simplest of things. If somebody who's an employee who's a good performer, or somebody who I have worked with closely, if I lose an important employee, I would really want to understand why.
Right.
Sometimes people are just making smart career choices. But you would want to understand why did that happen. If you have a disconnect with a friend, you lose a childhood friend, you would want to understand, why it happened,
Mhm.
right? Like yesterday, you thought that, for example, Delhi election result was great over the last few days. You felt that RBI rate cuts, the budget, the liquidity infusion, everything is great. Still, why is the market not going up? So,
Mhm.
these are examples, whether it is personal life, professional life, or the markets. For everything, we want clarity. We want to understand why. And we also know at the same time, anybody who is, a mature person understands that for anything that happens, there is no one concrete reason, or there is no one specific or definite reason, correct?
Hmm.
But still, despite knowing that there is no one right, specific, concrete reason for anything, we will still do well if we get some explanations, correct?
Hmm.
So what happens is that human beings, there is the whole market out there. There is a whole, there are careers made on providing explanations, really. But I think explaining something after it has happened has no predictive power. See,
Hmm.
when something happens and you give a perfect scientific explanation to someone that, listen, this is what happened and that's why this is how it's playing out. You feel like, oh wow, chalo, मुझे समझ में तो आया क्या हुआ है. And then
Hmm.
you start thinking that so next time onwards, I'll better prepare myself, you know. But if market occurrences or occurrences in your personal or professional life, if they surprise you, the learning is that life is surprising. The learning is that markets are surprising. The learning is not that I'll prepare myself better next time, because there is no end to preparing yourself better. The point is you are again going to get surprised. So if you get surprised in the markets, the learning is that markets are surprising, and you should ensure that portfolio is such that it can weather all kinds of surprises. I think that is the key thing to keep in mind. It's better not to predict. It's just important to prepare.
Okay. All right. So, like you said, markets are, going to surprise us and they are unpredictable, yet people try to forecast them. So, how do you think can investors shift their mindset from predicting to adapting?
See, the only way to do it is, very cliched, and our industry keeps talking about it. The only thing to do that is to not do anything which is deterministic.
Right.
People's portfolios are too deterministic. For example, in the last 3 years, everybody thought that, small and mid cap is the mantra. Everybody thought that, public sector enterprises, policy, macro driven sectors, cyclicals, everybody thought that that's the way to go. And, over the last 3, 4 years, I'm quite certain that anybody who had thought that their a small and mid cap exposure should be X percentage, I'm quite sure it's much more than X. If anybody understands that the BSE 500 benchmark, which represents 95, 96% of our market, if you understand that it's not growth or value, defensive or cyclical, it's a broad index. But in the last 3, 4 years, everybody's portfolios are tilted in favor of cyclicals, right? So what happens is that the only way to stay out of this is to not do any deterministic choices and make sure that your portfolios are balanced.
Mhm.
The second important thing is that make sure that you practice asset allocation, like balancing large cap versus small and mid cap, ensuring your portfolio is not tilted in favor of cyclicals or defensives, domestic stocks or export stocks, growth stocks or quality or value stocks, making sure that your portfolio is not tilted on any of these counts, making sure that your asset allocation just doesn't become equity oriented because equity is flying, right? All of these are asset allocation decisions.
Mhm.
And only a person who is adaptive, only a person who is probabilistic in their thinking, only a person who respects that life and markets are surprising, they are the only ones who will genuinely practice asset allocation and genuinely ensure that their portfolios can adapt.
Mhm.
But by and large, what I find that most of us are very deterministic. Why we fail to practice asset allocation is because we lose faith in asset allocation when we see that one or the other asset class is absolutely on a tear. Like last 3, 4 years, nobody realized the value of asset allocation because equity was just flying. Right.
Right.
But in the last 6 months, hosh ठिकाने आ गए होंगे, something like that, right?
Yeah.
So only people who keep in mind that nothing goes one way, eventually, things mean revert. They are the ones who will practice asset allocation. And like I said earlier, just to sum up, for success, I said one thing earlier that, for success, you have to be open-minded. It's also true that you have to be probabilistic instead of being deterministic.
Right. You also make a point that chasing top performing fund managers, it often backfires. So, what should investors really look for in a fund manager?
See, I think that we know very, very well that, every couple of years, the best performing fund manager changes. Correct. And it's not like these people lose their skills or something. It's just that when the macro environment changes, the factors that are driving the performance in the markets, when that changes, then different strategies get headwinded or tailwinded. So there'll be times when somebody's strategy is headwinded in the market, and even being a great manager, they look like they're doing badly. And there are times when certain factors or certain strategies make those strategies tailwinded, and those managers really come out in flying colors. But I think it's the market which actually maximizes somebody's performance. And sometimes it's the very same market, when conditions change, they minimize somebody else's performance. And this will only happen to managers who are on the extremes, right? Like if you see in 2016, 17, 18, anybody who had a portfolio which was, growth oriented, auto ancillaries, home finance, capital market companies, they were all flying. In 2019, 20, anybody with a defensive, high quality portfolio, they did very well, but they didn't predict COVID really. In 21, 22, anybody's portfolio with value, cyclicals, PSU, they came out flying, but I don't think they predicted Ukraine war, nor the PLI in defense or in defense indigenization for that matter, right? So what happens is that macro occurrences create headwinds and tailwinds for certain strategies. These macro occurrences are not predictable. I don't think anybody predicted COVID. I don't think anybody predicted Ukraine war. And I don't think anybody predicted that Mr. Trump will come back so strongly with a second term. Correct. So I think that, basic point is you should look for managers who don't swing for extremes. and who are more focused on consistency, who are more focused on generating optimal performance instead of maximum performance. See, there is nothing called anybody who tries to maximize, the market will eventually minimize them. You need people who respect the fact that macros are unpredictable. How markets will react to macros is even more unpredictable. So people who respect these facts and people who optimize for consistency, they are the ones you should back rather than backing people who maximize. Because the one, like I said, the ones who maximize, Mr. Market is going to turn back and minimize them eventually.
Right. Interestingly, you compare SIPs and asset allocation to chemistry rather than physics. So, how can investors use this approach to stay disciplined and avoid emotional investing?
See, one of the reasons why I have seen people are not able to practice asset allocation is because they are not probabilistic.
Yeah.
Like I said, so what happens, see, take an example. 2 years back, approximately 2 years back, we created a multi-asset allocation fund. Just giving you an example. At that point in time, because of the tax structure, everybody's multi-asset allocation fund had 65 to 70% in equity. And you know that equity has been on a tear. So people were getting great returns in multi-asset allocation funds, which were having 65-70% equity. And although it is multi-asset, they had only 10% in gold, example. Now, at that point in time, if I go out and create a fund which is allowed to buy 25 to 30% in gold and only 25 to 30% in equity, the questions I would get would be, man, why are you holding so much gold? It just doesn't perform. It's not delivered returns. Equity is doing so well, but you're not owning enough equity. Now, if you want to prepare for the market surprising you, if you respect the fact that markets are unpredictable, then you should be happy with a product which leaves all the possibilities open, right? So now see what has happened in the last 6 months. Gold is flying. Now, equity is doing badly. So when we created the product, it's not like we predicted this. When we created the product, we just said that we want a product which will tackle all probabilistic scenarios. And we want a product which will do well in every environment, not just in an environment which is tailwinded for equity. So that's why, why I compared with chemistry is because we all have learned chemistry in school and college. When you mix substance A, B, and C, they come together and they don't form something which is A plus B plus C. They form something which is alpha or beta or gamma, right? And when you evaluate that alpha or beta or gamma, it does not retain all the original properties of what A was or what B was or what C was. It creates something completely new after deriving the best of whatever it wants to derive from A and B and C. But it produces something completely new, right? So that is how asset allocation is supposed to be. If you mix debt and equity and gold, it's not additive that will give you returns of debt plus equity plus gold, or that it will cancel out one versus the other. Doesn't work that way. It is supposed to create a completely new combination which will behave differently in different market conditions and bring you a different set of risk return profiles. I think that is something which people need to keep in mind.
All right. So it boils down to balanced portfolios not tilted towards a particular style, asset allocation, and being adaptive and probabilistic. Well, thank you for sharing your insights and diving deep into your columns with us. We look forward to having you again. Thanks.
Thank you, Ruchira. Nice talking to you.